Good evening. It is Tuesday night. It's September 9th. The market has closed, and it has been a couple of weeks of knowing which stocks to pick has been the secret recipe for success. You can't just buy the index nowadays because some stocks are going up. Like today, we had Google going up, Meta went up, JP Morgan was up, Palantir was up nicely. United Healthcare coming in strong. They had some good news around their enrollments for their premium Medicare health insurance, came in real favorably, and that stock rallied. But some stocks didn't do too well. They materials sold off, looks like industrial sold off. Broadcom finally had a day down. That stock's been on a tear, just going up. And it's been an interesting time in the stock market. I continue to think that September could bring us a nice little down market, maybe taking stocks down 5-10%. But we'll see. We'll see what happens. Before I move forward, let me thank our newest member, Big House Juice. Thanks so much for becoming a member. Let me know if there's a stock you want me to look at, a symbol, and please get me your email address by emailing me at victorhinvesting@gmail.com, and I'll get you all hooked up with all the perks for paid members. And again, thank you. All right, so we are going to go through. I have a list of stocks that I thought would be interesting to cover, but my list is my list. I would love to see your list. If you'd like me to look at a stock and looks like Big House. Cool. So thanks for doing a best worst in retail. Appreciate it. Cool, man. Thanks for the comment. It looks like Saeed is on. Man, Saeed, you are always on. Thanks for coming on so often. I appreciate it. Appreciate all the questions. Let me know if there's a stock you want me to look at. Herdo, good to have you back. Great to have you, Herdo. And let me know if you would like me to look at a stock. All right. So the market was not necessarily having one clear direction. If we look at the U.S. market, the S&P was up a little bit, 20.27. The NASDAQ 0.37. Then Russell was down 0.55. So small caps took a step back today. The Dow was up nicely, probably because oil was up. Oil companies are in the Dow. So that looked good. Interest rates did drop today. It looks like getting a home mortgage is going to become more affordable because interest rates are going down. So interesting. Okay. So we've got that going. We had a couple of earnings reports, no big ones. And one that is dropping is Synopsys. Man, dropping 19.42. What does Synopsys do? Synopsys provides electronic design automation software products used to design and test integrated circuits. It operates in two segments: design automation, design intellectual property. These guys they're basically the supporting cast for semiconductor companies. Semiconductor companies design these chips and they think it's going to perform at a particular level. Synopsys helps them test that, and then they can validate this is the performance of the chip. This is what it can do. Now, the stock going down is a little bit of a surprise because, man, semiconductor companies are flying up. I mean, look at Broadcom. It's been just killing it. This company does have growing revenues. Looks pretty decent. 14% growth in the quarter at a $1.7 billion revenue quarter. That's not bad. But for the trailing 12 months, it's flat. I guess there was a bad quarter in there somewhere. And here's that bad quarter. The compares are a little tough because they were growing a lot. But overall, I thought the quarter looks pretty decent. You got 14% growth. Last year they grew at 15%. Not bad. All right. And when we look at their free cash flow, looks good, 1.2 billion. Really nice gross margin. And one thing I look at, so you have profit at 37%. That is really good. And you add that to their growth in revenue, that's a pretty good number. That's above 40 in a software company with revenue growth plus profit percentage. You add those two, and if you're over 40, that's a quality software company. They're growing and they're very profitable. Well, guess what, folks? We got a 50. Well, if you have a 50, you got my attention. Let's analyze this puppy. And I see your comment, Mr. 123 Cheetah. We're going to look at SIMO. SIMO is, on, as they say in baseball, on deck, ready to come to the plate. For now, let me try to finish up here on Synopsys because, sometimes I don't get why this thing's selling off. Let's see if we've got some news out there. So they reported quarterly revenue below estimates. Okay, so they missed estimates. Boy, they got punished. And what's your stock been doing? Year to date, the stock's up 24.5. Over the 1 year, it's up 30%. Over the 5 year, 203%. So when the big run up in NVIDIA was happening, Synopsys did have a really nice run from below 300 to above 600. Nice. And since then, it's had a hard time continuing that appreciation. Well, let's analyze it. Let's get to an intrinsic value on Synopsys and see, is the market just kind of have an attitude problem, or are they dealing with some real fundamentals that should be driving the stock down? So I'm going to open up another screen. I'm going to open up a valuation model that I've created, and we're going to take a look at Synopsys. Let me try to make some room here. Now, Synopsys is a software company. I'm going to put them right next to ASML. ASML makes these big, giant machines. Also, the supporting cast for semiconductor companies. And the semiconductor space is fascinating. So, all right, we got that. I'm going to copy the ASML valuation to use it as a template. And I know I've got a new member, so if you ever need, just ask me questions. If you ever have questions on the model, feel free to ask over email, comment on videos. I would love to take your questions to make sure that I answer them. All right, so Synopsys, the symbol is SNPS. So this is a smaller company. I might change the discount rate, but let's kind of get into their balance sheet first, and then we'll see what we're dealing with. So share count, they have 185 million shares outstanding. And I'm just reading their financials, so bear with me. So revenue is growing at 14% last quarter. Free cash flow. So I'm not getting all the numbers there. So I'm going to go to their investor page. and get that. So sometimes the stock analysis page is a good page. I like what they do, but sometimes the data doesn't come over completely, and I need to go to the investor page for the company and make sure that I'm looking at the right numbers. Okay, so we've got third quarter results are here. There's their revenue, 14%, looks good. These guys are in Sunnyvale in the Silicon Valley in California. Here is their revenue. Okay, this is their guidance. Okay. And then free cash flow, they're guiding they're going to do about 950 million. Okay, 950 million is what they're guiding for the full year. So that's a good number. Okay, so here they're guiding for 950. So we got that number. Now they are growing at 14%. So a 15% growth rate is fine. 4% long term, that's fine too. So now let's take a look at the balance sheet. Let's go back to that earnings report just to make sure we're getting the real information. So they should have a balance sheet in here. So here's their income statement. Looks good. All right. So the year we're focused on is 2025. Here it is. We got cash of 2,526 plus 67 million. Got it. Okay. That's 2,526. 4 plus 67. And let me grab the debt. So they have short-term debt of 22 million, long-term debt of 14,318. So we're at 14,340. All right. So their cash flow is this low. Man, I'm not even close to their valuation. So was that guidance for the quarter or for the year? Because that is really low. Interesting. Let's take a look. So fiscal year. So they're producing very little cash. Well, that's not good. Low cash is no good. They are growing nicely. They have earnings per share. So this one's just not going to cut it. It is not going to cut it. That's just not enough cash. I can produce better cash with other semiconductor stocks, or even Lam Research produces more cash. I know that for sure. And ASML produces better cash. ASML is discounted. So why am I going to go look for a stock that can't cash flow enough? Maybe that's why the market's like, you know what? If you're not going to grow really intensely, you don't have the cash flow to sustain your stock price. So I am out. That one is not even close. So Synopsys is selling off. I can't think of why the stock is at $604 per share to begin with. So I'm going to move on. All right. Thanks for bearing with me. Give me a second here. Let me catch up on comments, and then we're going to hit SEMO, and then we're going to hit Celsius. All right. Celsius it is. Celsius, the energy drink. And They've been making some noise lately. All right, so let's take a look at SEMO, and then got a woohoo for GameStop. Yeah, they announced. We have time. We can take a look at that one. All right, so SEMO. Silicon Motion Technology Corporation, together with its subs, designs, develops, and markets NAND flash controllers for solid-state storage devices and related devices in Taiwan, US, Korea, China, Malaysia, Singapore, and internationally. Okay, so these are solid-state drives, and all you gamers out there, you know a solid-state drive is faster. That's what the gamers use. But in high-end computing, you also want solid-state, so you have the read access to be that much faster. So those are premium hard drives. This is a $2.85 billion market cap company, revenue $768 million. All right, so you're not paying too much. The PE ratio is a little high, and this is a hardware company. So I'm going to take a look at their margins, because hardware companies tend to have lower margins. So we got to make sure we're getting a really good price, and we feel like this company is growing. Year to date, this stock is up 55%, 1 year up 47, 5 year 138. So it's had its runs, and it's had one here recently, along with a lot of stocks in 2025, but it hasn't had a long-term upward trajectory on their stock. A lot of the gains came out of, I guess, 2020. It came back down. So let's take a look at their financials. So when did they announce last? These guys announced they will be announcing on October 29th. So I imagine they announced in July. Late July was their last earnings announcement for covering the quarter that ended June 30th. So the revenue isn't looking too hot. Let's take a look at the quarterly, see what's going on. Yeah, we've had 1, 2, 3 quarters of negative growth on the top line revenue. And revenue tells us, is this company's products, are they succeeding in the marketplace to get more customers to buy their solid state drives? And the answer is, for the last 3 quarters, fewer customers bought their product. They are losing ground to their competition. They were on fire for a little while here. Look at that. Beautiful growth. But it looks like it was cyclical. It turned on, then turned off. And it's not the first time that's happened. In 2019, it happened. So these are the types of businesses where once they have all the hard drives they need, they don't need any more. These hard drives last a long time. So we don't have any growth. That's a problem. Okay. Because based on a PE ratio of 36, you're supposed to be growing. You don't have a 36 and you're not growing. That's a problem. I could buy Google at a 26, 27 PE. That's growing at 13%. They're massive. I could go on a long list of stocks that have a better PE that are growing. So that's an initial first red flag. Not growing, high PE, we got a problem. Cost of revenue is a little high, so the gross profit isn't going to be great. So these guys, very little cash flow, 30 million in the trailing 12 months. That's anemic, very low. Gross margins of 46. That's not bad for a hardware company, but it's not great. We saw a software company in Synopsys, like 80% gross margins, and overall profit margins like 20%. These guys are at 46 and then 10%. So not very profitable. It's a good business, but it's not very profitable. So these guys are probably not going to be, when I value them based on cash flow, we're not going to get anywhere near their stock price. Let's see 2 more things. The forecast, what are analysts saying about the stock? Are they thinking it's going to grow? So we are in this year here, very slow growth. It's actually been worse than that. It's supposed to grow some next year, and then it's going to slow down again in 2027. The profitability is going to expand, and eventually it'll get that PE down. But right now, they're kind of underperforming. They're under executing, right? They're not growing their business. It's the market is buying other products and going to their competition. Yet the stock is really moving. Interesting. It's interesting that year to date, we're up 55. Even the 1 month is up 10%, but the performance is going in the opposite direction. They're losing revenue. So that's interesting. And a little bit of contrary to what I would have thought. If the stock price is going up, I would expect revenues doing really well. So it looks like they just have cash and no debt. That's very good. So on this one here, I'm certain I'm not going to get to the stock price on cash flow. $30 million just doesn't get me much. Could I substantiate it based on earnings per share? I think analysts could. They probably say make a case for it. And it looks like they are saying that it's fairly priced at their current stock price. There is an analyst that's saying that the stock should be priced at 65. The best case is at 95. All right. So this one here is going to be a hard pass for me because 30 million, the best I could do is maybe get to like $500 million to $600, million. And we're not even close. So this one here is not looking too good. I don't love hardware because the margins aren't great and it tends to have cyclical conditions. Software, if you look at some software products like Intuit, for example, some of you may be like TurboTax customers and you have to buy that every year. It's not like, hey, I'm not going to do my taxes this year. No, you do your taxes every year. Or a business that uses QuickBooks from Intuit. It's not like they're going to stop doing their books for a year. No. So you keep paying into it. You keep paying them like you pay your Netflix bill, you pay your Spotify bill. You just keep paying. It's a cost of doing business or a cost of, earning money in the case of TurboTax. Well, hardware companies don't have that luxury. They have revenues that come in, they sell product, and then they have to go find the next customer. It's not a reoccurring revenue that software companies enjoy. So I'd rather have software or intellectual property like companies versus hardware companies. All right. Thanks so much, Mr. 123 Cheetah. Good to see you. It's been a little while since we've seen you on a stream. Great to have you. All right. Let's move on to Celsius. Let's kick it up a notch. Let's get the Celsius analysis. So Celsius develops, processes, manufactures, sells, distributes energy drinks. All right. So they're kind of an up and coming energy drink company. They're trying to, take some market share away from Monster and Red Bull. Monster, I think, is the market leader. Red Bull's in second place. And I don't even know if Celsius is third, but they're substantially behind those companies in revenue. This company has had kind of a wild ride. The stock really rose and then it really came down. I think Monster came in and took over some of their distribution and kind of cut them out by making some bigger deals with some distributors, and that really hurt them. They've come back. Look at that. Year to date, up 112%. Wow. Very nicely done. So $14.46 billion market cap, revenue of $1.67 billion. PEs are a little high, strong buy, 11% discount. So this business figured out, this is when they were just growing like crazy. And Monster saw them as a threat and probably gave distributors these really good deals or really good arrangements and took some business away from Celsius. But they kind of have responded or rebounded and figured out how to grow. Good for them. And the latest quarter, look at that growth. Man, nice growth. The compare is to this quarter. That's not a bad quarter. So they are back, man. That's really impressive to see a small company, when they're dealt kind of a bad hand, they lost some revenue. One of their main competitors is against them. And they figured out, all right, well, we'll sell over here and figure out how to get our product to our customer. Nicely done, Celsius. So the growth looks good. And let's take a look at their profitability. This is energy drinks, right? So there should be some profit in this. 50% gross profits. Now, Celsius is a newer company, and I imagine that they don't necessarily own the factory where, the bottling factory or the canning factory, because I think Celsius gets sold in a can. They probably have a contract with a bottler, a filler that basically contracts with all the beverage companies, and they just produce this stuff. You give them your recipe, they mix it, they brand it the way you want it, they case it, and then they distribute it to where you need it to go, either to your warehouse or maybe directly to your customer. So that happens. They don't have to put a lot of capital in, but they give up some of the margin. 50% margins in the beverage business, that's fine. So they have very good growth. They have some profitability. So that looks good. That's why the stock's really moved. Is this stock is taking over some market share of the energy drink market and staking their claim, trying to stand up to Monster and Red Bull. So this one looks pretty good. I like the growth turnaround. Let's take a look at their balance sheet and then their forecast, just to make sure we know what we're dealing with here. Okay, so cash 618, good. And that's 615, excuse me. And total debt is 896.92 for debt. So the debt and cash are pretty close. They have very little debt. That's good. That's very good. Small companies that have debt, it really limits their flexibility. And if they have to pay interest, takes away their cash that they need to grow. So on Celsius, we have 18 analysts covering them, and there's a wide dispersion on price targets. One analyst believes, hey, it's a $90 stock. Another analyst, no, it's only a $32 stock. And on average, it's discounted by 11%. I like looking down here, number of analysts that are commenting on the forecast for revenue growth in the future. We are right here. This year, it's expected they're going to be a $2.4 billion revenue company. They would have achieved a 77% growth. Nicely done, Celsius. And they're going to be profitable. They're going to keep that growth going one more year. The growth is going to be a little slower because they keep getting bigger. Then they're going to kind of plateau in 2-3 years. Their profits are going to expand nicely, so that looks really good. So it looks good. Earnings per share. And I like using, since we're already like well into this year, I'm going to use the following year, because we are projecting forward what is going to be the profit in the future. And 147 a share is what I'm going to use in the valuation of Celsius. All right, so let me take a look at free cash flows one more time, just so I can note that. So free cash flow, and you see how this went from, they weren't making much, had a little negative cash flow, which is understandable when they're starting up. And now they're sustaining themselves above $200 million of free cash. So that looks good. So that is 210.84. Shares outstanding are I'm going to call it 258. All right, so let's value Celsius. This is a beverage company. And I can't say that I've got a beverage company in here. What's the closest thing that I got to it? I'm going to go with Starbucks. Different business altogether, but about the same margins. If you study Starbucks, they do about that margin rate. So I don't cover a lot of beverage companies. It's just not the kind of stock that makes me spring out of bed to see what's going on. I like tech, communication services, healthcare, some biotech. That's pretty cool. All right. So change the date of when I'm doing this valuation. We got Celsius. So the trailing 12 months was 210. Okay. Now they're growing quite a bit faster, and their growth was not like stable. It was pretty exciting. So I'm going to go with growth for the first 2 years. And actually, you know what I'm going to do is just copy this up here. And I'm going to go with growth year 1 and 2. And we're going to go with 50% growth there. And then after years 2, 3, and 4, I'm going to slow down the growth, because they have like this really nice growth, but it's not permanent. So we're going to go to 10%. And then since they're smaller, I expect they're going to continue to grow and eat into that big market that Monster and Red Bull have. They're just going to keep chipping away, eating at their market share. All right, so this guy here, we're going to grow that, and we're going to move this up one field. We'll move that guy up one field. All right, so now we're getting somewhere. So we're growing years 1 and 2 by 50%. Then we're going to slow it down to 10, and then we're going to grow 10%. So we had cash of 615.23, and we have debt of 896.92. So our shares outstanding were 258. Man, look at that. We are fairly priced on cash flow. And on earnings per share, 147 per share. It's a growth stock. It's not in my favorite industry, so I'm going to tone it down a little bit. We're going to grow that by 25% per year. So I am showing that Celsius is close to fairly priced. And a stock like this, I would be patient and wait for it to sell off. I know that it looks like it's never going to sell off again, but it did before. And we might be getting a little too late to this stock. For the 1 year, year to date, it's up 112%. It's like, geez, when's this thing going to cool off? I mean, it looks like a easy investment at 42 now, right? So I would do, show some discipline and wait for this thing to pull back. Maybe offer me a 30, 40% discount based on value. And if they don't want to show me a nice discount, I'll move on to another company. I got thousands of stocks to choose from. I don't have to buy Celsius. But if they offer me a really nice discount, I believe these guys are going to be successful. I really like how they've shown that they're resilient. They were pushed back by Monster. They figured out how to come back and start growing. That's awesome. So if they can sell off and I could buy under the right conditions, this might be a good buy in the future. For now, it's just a watch stock. I'm just going to watch it. It's like being a a patient fisherman, right? You may not, if the fish aren't biting, the fish aren't biting. You may have to wait and come back another day or do something different. But I wouldn't chase a stock because you can lose your capital, or you can lose part of your capital by chasing stocks and buying them under the wrong conditions. I like buying stocks under the right conditions, and there's plenty of choices out there. So thanks for asking about Celsius. That's where we ended up. We just valued Celsius from the ground up based on cash flow and earnings per share. All right, so we covered Celsius. And we've got, let's see here. So we covered SEMO, the Great Randinor 3. So Lumen Palantir, Lumen Technologies deal. There's a deal between those companies. Interesting. So Mr. 123 Cheetah, you got SEMO. Cool. Okay, Mike, good to see you. So let's talk about Upstart. I don't know that I have Upstart in here, so let's take a look. No. And this is the buy now, pay later company, right? So personal lending, auto lending, and other. Yeah, we take a look at this. So personal loans, dealers. So car loan refinance, short-term relief, home equity loans. I think this is HELOC. Okay. So this is a lender, new generation lender. So let's take a look at their financials. So this is a $6.63 billion market cap company, $884 million in revenue. Forward P is 34. We'll see how they're growing. The stock isn't overly heated. It's up 12% year to date, up 100% over the 1 year. Wow. Now this stock got really bid up and then it crashed down. So since then, it was really low priced and it really rewarded investors that came in here. Hopefully you're one of them, Mike. All right, let's keep going, see what their growth rate looks like. Looks like the trailing 12 months growth looks really good. We got 90% in the most recent quarter. And Q1, they have a fiscal year, I guess, that ends, it just ends December 31st, like calendar. This growth looks really good. Really good. So that growth is real. So these guys are lending money. So I'm going to look at their book value and then value them based on earnings per share. So when we deal with banks, we can't use free cash flow because banks could see how wonky their cash flow is. They're going positive, negative, negative, positive. And banks are like, their product is capital. Their product is taking in deposits and paying deposits. It might be that Upstart takes in capital from institutional investors that say, hey, I'm going to lend you my capital, but you're going to pay me 6% or 7%. And then Upstart turns around and lends it out, and they're trying to make a couple of percentage points, net interest margin. That differential of I'm paying my depositors 5%, I lend it out at 8%, I just made 3% on all the loans I made. That could be highly profitable. So you don't price or you don't value companies based on cash flow that have that type of business. You look at book value and you want to make sure that the book value is growing. The book value represents the value of that bank, or in this case here, it's a lending company. And then we're going to look at earnings per share. So the book value, we're going to find it on the balance sheet. And it'll be toward the bottom. So here's the book value per share. Now it's been a little bit of an up and down situation here. 965, 828, 736, and it came down quite a bit. Now it's beginning to grow. So that's why the stock's working and the book value is expanding over the trailing 12 months. So that looks good. Now, it's beginning to work, but it's not showing a long-term track record. So it's a little bit of, this is a riskier stock. It's smaller. They're not proven. You see that their book value was declining. It's not like JP Morgan that's grown their book value for like 10 consecutive years. All right. So let me take a look at their forecast and the forecasted earnings per share. So we've got 14 analysts covering Upstart. One analyst believes they're worth $108 per share. Another analyst, wow, $16 a share. Wow, there's a big disagreement on the value of this company. And on average, 7% discount. So when we look at their forecast, it's expected that they're going to continue to grow. They're having a really good year of growth. And they're going to continue to grow for a couple of years. That growth looks good. And their earnings per share looks really good. $2.56. And it's really expanding fast. So that looks good. All right. So I do have companies like Upstart that we cover. And the company that I want to match these guys up to is SoFi. The other thing about banks is you oftentimes see me look at debt to EBITDA. Well, those ratios don't apply to banks because they want debt under the right conditions, right? Because debt and capital is kind of like their product. Like NVIDIA makes GPUs and semiconductors. A bank, they're trying to create really good financing for their clients and make money at the same time. And they need that capital in order to do so. All right, so Upstart. I'm going to go with a higher discount rate because I'm a little I'm cautious with these companies because they could have a surprise if they don't make the right loans. It could be a lot of losses. So they are growing nicely. A 36. Okay, I'll go along with it. And 25. They're going to grow by 25%. So based on earnings per share, this thing does price out correctly, or I should say at a discount. And then the book value, this is for a bank. So I'm not going to value it based on book value. I'd want to do more homework. And they haven't shown a consistent upward trend on book value. I would just say that it's a risky stock. And if you used earnings per share, which the market is going to use earnings per share for Upstart, it's showing a discount of 40%. So if you're comfortable with Upstart, you believe in the business, I couldn't argue with an investor that wanted to buy into it, especially since they're a $6.6 billion market cap. These guys could really grow quickly and be a $30 billion market cap. So that's where I'm going to get to on this one. And if I look at it again, I'd probably update the book value. Write myself a note. So thanks for the question on that, Mike. And I think you own SoFi, if I remember correctly. And what I don't know what the shares outstanding are, but it looked it up for me. Yeah, 6.6 million. So Upstart, I think, has potential. Now, I'm not invested in any company like this. I'm just afraid of, they're using algorithms and so forth to make these loans. And man, they may pull it off and it might become like a huge business. I just don't quite understand it and have all the confidence in there in companies like this. So I'm going to sit it out on this particular industry. I do have some of this in PayPal, and PayPal does have buy now, pay later in their business. So thanks for asking, Mike. And yep, you've owned SoFi 4 times, made money on it. Nice work. All right, so we covered Upstart, and then the rules of going over stocks. If you're a member, like many of the people on the stream, I just review stocks for members. And if you're not a member, don't want to become a member, $5 super chat, and then I'll cover your stock. So that's how I cover stocks. Thanks for attending, Wet Karma, and everybody else. All right, here's another questions. So, did you guys buy the stock earlier? I mentioned WLDS. So this is the one that you said they got approval on a drug, correct? And they flew up. So, no, I'm sorry, a patent. It's WLDS wearables devices. Am I looking at the right one? Yeah, I didn't look at this one, Mike. So am I looking at the right stock? I think I am, because you're talking about $1.50. If it drops to $1.50, but it's at $1 and it's up. Oh, okay. That's why you brought it up. It's up 125%. Jeez. So what do these guys do? Wearable devices. Okay, the human hand. So they create these bands. And what do these bands do? Like monitor your health symptoms? So biometric, robotics, defense. I guess with this band, you'll be able to like control, kind of like the controllers for Oculus and so forth. You're kind of using the controllers to kind of mimic the human movement. Is that what we're talking about? Or it's actually picking up the signals from your brain, and you're kind of communicating to the device and saying, hey, once you do, wow, that is pretty cool. All right. So why is your stock price down so much? So the neural input. Okay. That sounds really interesting. All right. So it's a cool product. Let's take a look at their financials. So they're going to double overnight, but it was $1 stock. Okay. So I'm not expecting beautiful financials. Yeah, like I said, I'm not expecting beautiful financials. They're not making much revenue. This is basically $500,000. So $520,000 in revenue. And Cost of revenue, $440,000. So they had a little bit of profit, but operating the business cost them close to $8 million. So they've lost some money. So this is a tiny cap, right? Yeah, $1 million valuation. Wow. There's micro cap, and then there's super micro cap. Not to steal Super Micro's name, but I couldn't think of any other adjective. This is tiny. Go, Mike. Now these guys, obviously they can go up 125%, and that means the market cap is going to go up $1 million. Okay. All right. This thing can go 10 bagger in no time. All right. So they don't have a lot of revenue. They are spending more than they make. No margins yet. Eventually we'll see what their margins are. This is a device. So how expensive is it to make it? We don't know yet. Let's see how much cash and debt they have. So they have $4 million in cash. They have $1 million in debt. So they have $2.8 million or so of cash. So they have some cash to work with, but they are burning it quite quickly, right? If we look at their burn rate, the free cash flow, it'll show it to us here. They're burning like $8 million a year. They've got less than $3 million in cash. So they better get an investor to inject some capital, or they're going to issue more stock, but I don't see how they could issue stock because their stock price is already at $1. So this one's exciting, but it's not my game. I'm not seeing fundamentals. The only way I would invest in a business that's this small is if I was personally involved and really knew what was going on, if I really believed in the technology, because this is going to be a pretty risky stock. It didn't get to $1 because it was doing great things and everybody loved it. There's a lot of doubt. There's a lot of doubt in the market for it, but it's going up 125% tonight. Hopefully it looks like you're out of it. You made some money, sold out. And if it drops, you're going to buy it again. All right. And I agree with your comment. Rate cuts will help Upstart. Again, back to what is their business? They bring in capital. And if you have really low interest rates, Upstart is like, hey, I can get capital for 3-4%. That's my cost of capital. I can lend it out for 6-7. Maybe my customer doesn't really care about the particular rate that I'm charging them, but they want convenience or they want other benefits of doing business with me. And their net interest margin is 3-4 full, or 300 basis points, as finance people would call it. And that's a really good margin on their business. So I agree with that. And I know you're a SoFi fan. Absolutely. You stick to SoFi, I'll stick to Robinhood. You make money, I make money. We all make money. All right. So Zion Luca. Yeah, I can grab a $5 super chat or become a member, and then I could take a look at it. All right, perfect. You sold WLDS at $3 a share. Nicely done. Very nicely done. All right. So we've covered a lot of little stocks here. Let me make sure I didn't miss anything. I think we're good. If I missed your stock and you're a member, please put it on there again. I don't think I missed anybody's. All right. So let's keep moving. I wanted to cover a couple more. And of course, if you guys have another stock, we can take a look at that. All right. So one stock that I've been kind of watching, I started buying into it, is Root. And these guys, we just went over Upstart, which is like, hey, we want to do financing a new way. And we think we can better connect with people that are, going to use their phone or their computer. All the process is going to be digital, no bank involved, none of that stuff. And you can do very good financing that people appreciate. Well, Root is a new generation insurance company, and their intent is to just go purely digital in the experience to the customer. Really small cap, 1.5 billion, revenue 1.36 billion. PE ratio looks rational this year. It's going to expand next year, go up. And analysts think it's discounted. Year to date, this thing is up 35%, but you see that it's sold off. So this, I thought, created an opportunity for me. So I started to buy into this stock. It's up 157% again. It went up and then it's really come down. And this is the trough that I started buying into. So this is a growth company, 59.76, looks good. And the reason I wanted to look at it is last 5 days, take a look. Last 5 days had a nice run, kind of pulled back a little bit, but I like what it's been doing. This one here, I had kind of a nice starter position and want to see, do I want to add capital to it? All right. So these guys are, I own Allstate and I've owned other insurance companies. Yeah, it's similar to Lemonade. Matthew Connie, it's similar to Lemonade. I agree. They are growing nicely. Quarterly, 32%. As they get bigger, that percentage is going to go down just because they're getting bigger. They're in the billions now. They used to be in the hundreds of millions. Now they're in the billions. So that looks good. The growth rate looks really, really good. They are cash flowing. Beautiful. That means they can keep growing. These companies that are fully digital, like the SoFis, the Robinhoods, it takes very little capital for them to grow. It's not like, oh no, we need to build a new factory, or we're a restaurant. We need to open up new stores. We have to put a bunch of capital in. No, they just have to get the right recipe for success and they can grow very quickly. And their brand and their experience becomes very desirable, and they just take it and run with it. Eventually, they should diversify and make themselves very sticky with their customers. So these guys are at 197 free cash flow, and they are profitable. They have really good growth. So those are the numbers that really attracted me to the stock: is high growth, they're already cash flowing, and they're profitable. So from this point, I think they're going to continue to rise. So their balance sheet, more cash than debt. So they have $444 million more than they have debt of cash. So, I mean, these things, it's a good looking stock, man. I'm glad I bought it. No buyer remorse on this one. The other thing that's interesting, got 5 analysts, not a lot of analysts, but they're kind of in somewhat of an agreement, right? They're kind of flying in tight formation if they were a squadron. And they think it's discounted by 32%. As we look at what their consensus on the growth is going to be, this is their current year. They're going to keep growing, and they're going to be a $2 billion company at some point. This is the insurance business. And what is good about the insurance business is that they can continue to raise policies or rates. And, the insurance companies like Warren Buffett, he bought Geico because there's a lot of money to be made in insurance. It's not the best business in the world, but it's a good one. There's some businesses that are probably better, like Reddit with social apps, Meta, or Google with YouTube. These are phenomenal businesses that are just, so valuable. But hey, I really like what these guys are doing. I'm glad I bought the stock. Let me show you where I valued Root. See, look at this discount because they're growing quickly. I'm not even getting crazy on my growth rates. I'm just kind of saying, hey, this is their free cash flow. What would cause them to have to put a lot of capital into the business? Well, I can't think of many things, because if they have a very good digital experience, which they do, you just need to keep that experience, going, and get more customers, be really good at marketing. And if you look at like insurance, if you watch 2 football games, you'll see ads from 4, if not 5 insurance companies. I could probably cite the companies, right? You have Geico, you have Liberty Mutual, and you have Peyton Manning with what's the insurance company he covers? I forgot. Then you have Allstate with the funny guy that's always wrecking havoc. So my point being is the marketing cost is a big factor for insurance. Well, Root's going through a different direction, which is all this like grassroots kind of advertising on social, advertising in new innovative ways, kind of connecting to the next generation customer, and they're being successful. And I think if they build a really good mousetrap to get new customers, it's going to really separate them. I think they got something good going there. So just when I value this stock, just using normal growth rates, not even the accelerated growth rates that they're experiencing, this one looks really good. So I'm thinking I could feed this one a little more capital. I think maybe next week I'm going to start feeding it more capital and up my investment in Root. So that is Root. Big House. Big House Juice. What would you be your entry point on Fubo following the merger of the Disney? So is Fubo going to be acquired, or what is the situation? Is it so? So Fubo is being acquired. So they're going to merge with Hulu and Disney. Disney becoming the majority owner of the combined entity. Okay. Supposed to close in the fourth quarter of 2025 or the first quarter of 2026. All right. So, okay. So they're going to merge, be acquired. So are stockholders, and what is the acquisition price going to be? That's the second question. So Fubo did not have a single fixed acquisition price, but rather entered in a definitive agreement in January 2025 with the Walt Disney Company to combine its Hulu and live TV business with Fubo. In exchange for a combined entity as part of the deal, Disney, Fox, and Warner Brothers Discovery made a total cash payment of $220 million to Fubo, and Disney committed to a $145 million term loan. Okay. All right. So this deal is a little bit fuzzy because so the stock really rose, then it came back down because the terms are kind of not clear, not transparent. It's not like an acquisition where a company comes in and says, "Hey, your stock's trading at $4. We're going to give you $6." Now investors know I'm going to get paid $6 per share. It's not clear. And I think that's what's kind of making the stock kind of bounce around. Usually when you see an acquisition, they announce the price and it pretty much sticks to that price. Let's say they said $5, we'd follow that $5 line. This one here, now, Big House Juice, this one here, you might be able to play and make, I don't know, 10%, maybe 20. If the acquisition is going to happen, it looks like the market's pricing at around $4. We're getting closer to the fourth quarter. So there's going to be very little money to be made, in my opinion. Now, I don't play situations like this. Whenever I've had a company stock acquired, I just kind of take the money. I pretty much redeem my gain and I move on because it's just going to kind of be a distraction. I'd rather go find the next stock that's going to make me a lot of money. So this one here, not sure if investors are going to make much more beyond $4 per share. And it's interesting to see how it's going to play out. I think, online, needless to say, linear TV is just getting annihilated and everything's streaming. And, YouTube had, I think, its first football game on Friday night, and that was a really good experience. It streamed really nice. And who was it? Was it the Chiefs and the Chargers? And then they shot that guy out of the cannon at the very end. That was very entertaining. and it was a pretty safe cannon. The guy was like just sitting down and it shot him into the lake. That was really cool. All right, so we covered Fubo. Cool. Very good. Mike. Nice. You got it at $2 a share. Nicely done. Doubled your money. Nice job. Okay, so we covered Fubo. Let's cover another stock. Keep them coming if there's another stock you want to look at. We covered Root. Now, a stock that's kind of just lurking out there, kind of a young tiger in the tall grass, Oscar Health. And this thing, it moves. What's the bait on this? 1.87. Where's Daryl? So Daryl, we do the Monday streams together and I do the evening ones. So solo. So Oscar Health, this thing can really move up and down. For the 1 year, it's up 18%. Year to date, up 49%. And the good news is it gives you really good places to buy the stock. More recently, it's really done well. I noticed that, hey, 30% rise. Very nice. Now, Oscar, along with a lot of healthcare stocks, really took a beating because there's a lot of negative stories around healthcare. And now we're beginning to see, for example, United Healthcare came out and said, hey, the enrollment for our premium Medicare plans, which, people that are in Medicare, they can buy a supplemental plan and have healthcare with United Health, we're getting the enrollments that we guided towards. So the business is going to be strong. And I think Oscar Health has got a strong business. Their business is growing. United Healthcare is gigantic. Oscar Health is small compared to United Healthcare. And it's going after an addressable market that the big guys are pretty much ignoring. So this one here is one of those stocks that I continue to put capital into when it sells off. I haven't needed to put capital into them in maybe a couple weeks because the markets help me increase my investment in Oscar. As it rises, the market's doing my work. My investment has gone up close to 30% in the last 30 days. Thanks, stock market. I didn't have to do a thing. Just watch the stock go up. And this stock here, I feel really good about because of its growth rate. Really nice growth. Growth tells me that customers like the Oscar experience, the pricing, the product, the way they have it, presented to and they focus on individuals that need healthcare and small businesses. And those people are liking the product from Oscar. So that looks good. And we look at other fundamentals like cash flow. I mean, they are cash flowing really, really well. Much better if you look at it call it per $1 billion of revenue. They cash flow better than United Healthcare or others. So that looks really good. And the the profit margin for now is not a big concern because they're relatively small. For an insurance company, they're small and they're getting bigger over time. So we've got Oscar, the forecast. Let's see if this has changed at all. 7 analysts cover it. Wow, look at that. They all went from here to here. It's the negative stories that all these analysts and the news media have told themselves about healthcare, all this negative stuff. And they have the stock really priced low. They think it's currently priced 39% too high. I disagree with that. I think that the stock's going to continue to grow. Now, I don't completely agree with this forecast because health insurance is not one of those things where people turn it on and then turn it off. No, you have healthcare. If you value healthcare, you're going to have healthcare for yourself and your loved ones because, you don't want the year you decided not to have healthcare, you get really sick. That's going to really cost you. So I think they're going to continue to grow. They're going to grow nicely here. They're going to grow nicely here and here. And Oscar is one of those stocks that I think is going to continue to rise along with United Healthcare. I've been saying that United Healthcare is kind of a very obvious opportunity, and it's beginning to play out that way. I think Oscar is an exciting opportunity. Not as obvious as, United Healthcare. It's a little riskier, which is why I go with an 11% discount rate to compensate me for that risk. But once I add up all the numbers, I'm like, geez, I get a discount and I have terrific upside. These guys are a small cap right now. United Healthcare in their height was massive. Okay. And I was a United Healthcare stockholder near the top. I sold, but when they were here, it was a $600 stock. So not quite double from where they're at now, but basically they were near 600 billion in market cap. When they were at their height, they were like a top 10 most valuable company in the market. And then they had a string of problems, and here's where they're at now. Where I'm leading is Oscar is tiny. They're little. They can get to 50 billion in market cap and still nobody pays attention to them. Well, thank you very much, stock market. That'll multiply my investment times 9. I'm good with that. I'm totally fine with that. And this is a space, healthcare represents like 18% of our GDP. It's a massive addressable market. And Oscar's trying to grab just a nice little corner of it that'll make them, I don't know, $50, $100 billion market cap company. So if that happens, I would love to be along for the ride. So that's Oscar Health. I think they're doing well. We'll see if they can keep this rally going, that would be excellent. All right. So you and I disagree with the analyst. Thanks, Mike. Appreciate it. All right. So we went over Oscar. Let's go over Opera. Now I'm not going to sing Opera. I'm going to talk about a browser. And we're going to talk about a browser. This is a company that operates in Europe. They have a browser. Let me show the product because this thing really does show well. And this is a company out of Norway. They have a browser. This is what it looks like. Of course, we all know what a browser is. It's just like Chrome, and it's built on the same open source platform that Chrome is built on. Now, this stock, interestingly, before the Department of Justice made their decision that, hey, we're not going to break up Google. We're not going to break them up. We're going to let them continue pretty much as is. They can keep paying Apple for being the default search engine and all that good stuff. But before that, it was like, well, Opera is a browser, maybe they're going to get more business if they break up Chrome. And what was interesting is when the news came out that Google isn't going to be broken up, this stock rallied. That's interesting. And my theory is that, well, like OpenAI doesn't like that their users on a PC or on Apple notebooks and so forth, they have to use their competitor's browser, Chrome, to access OpenAI, or think about Anthropic, or think about all these other AI companies. Well, they could acquire Opera for less than $2 billion. Boom, you got a browser, a nice functioning browser. This business is growing by close to 30%. So I thought this was a nice little company with a product. When you look at, this is a software company, you're at 30% growth rate. You got cash flow, beautiful. You got profits of 14%. So that's a really good ratio for a software company. And I picked it up. I thought at a good discount. I'll show you my valuation in a minute. 5 analysts cover it. They all think it's going to go higher. Well, that's good. They think it's discounted by 27%. And looking at the expectations for revenue growth, we've got this stock's supposed to keep growing year after year. That's going to be good growth. They're going to get close to $1 billion in 3 years. That is great stuff. I would love for this one to get acquired. They just give me a little bit of time to buy more shares. And when I look at Opera, using a higher discount rate because it's a small company, so I'm taking a higher risk. I'm getting a growing business that cash flows, that has good profit at a 40%, 47% discount. What else could a guy ask for? And a part of it is that to some extent, software companies have been neglected because the AI build out has just consumed a lot of capital for semiconductor stocks, the utility stocks. There's just a lot of capital going into that environment. And a lot of good software companies are kind of being left unattended. And I think Opera is one of them. But maybe investors are now paying attention to it. That'd be great if it keeps rallying, and I'll keep owning it. So Big House. Nice. Let's keep it going. So here we got a question on Hood. So Hood is gaining. Dude. Hood is like, I thought they were a neat company when I started buying them some time ago, and they just keep rolling. And the latest news being that they're going to be included in the S&P, so they'll automatically get this new demand for shares because the S&P, like all the ETFs that want to resemble the S&P, they're going to have to buy Robinhood stocks. There's going to be a big purchase of Robinhood stock. But Robinhood's just been a great, great producer of appreciation for my portfolio. Thank you, Robinhood. Nicely done. And this stock here, kind of going back, lesson learned, right? Is growth, innovative way of going to market. They didn't copy old brokerages and just try to do it better. They're like, no, if anything, we're anti-establishment. We want to give power to the individual investor. They really went after that market. They do crypto. They did crypto early when a lot of other, kind of established investors were like, oh, crypto's bad. And those same investors are now saying, oh, crypto's great. Well, Robinhood from, a very early time, they're like, crypto's good. Crypto, for those that want to buy it, it makes a lot of sense. So they did a lot of innovative things. And the most recent thing they started doing was they call it it's gambling, but they call it something else. And they're putting it on their website. So if you or on their platform, if you want to guess at, who's going to win the football game, I think there's one Thursday night. I don't know who's playing, but you can bet on one of the teams or something else you can bet on there. And I think that's a new thing. My son tells me about this. There's another platform. I forgot what it was called, but that's becoming something bigger, and Robinhood's all over it. So go Robinhood. All right. So we went over opera. I spared you guys a couple singing lines. Wix. So speaking of software, Wix does websites. And this stock, I've looked at it for a couple of years, and I thought I wasn't going to like what I was going to see, because I'm like, I've seen it before. I'm like, don't like it. And then more recently, I think one of the members said, "Hey, can we look at Wix?" Absolutely. But I even told them early, I don't think I'm going to like what I see, but let's go. And I really liked what I saw. $9.3 billion market cap, revenue of almost $2 billion, and growth. Okay. Pretty decent growth, not breaking any records, but they're nearing a $2 billion revenue number. That's pretty good. Let's take a look at their margins. Gross margins, 68%. Yeah, that's very respectable. Profit margin, 9%. Free cash flow margin, 29%. Okay. We can work with that. So I thought, man, Wix is like looking pretty darn good. Year to date, market said, Wix, we don't know what to do with you. We think AI is going to do something to you. We don't know what it's going to do to you, but it's going to do something bad to you. That's nuts. So I picked up the stock and picked it at the right time. This thing's just gone up, and I think it's going to stay up over the long haul. I'm sure we're going to have a pullback at some point. It can't be a trip to Disneyland every day on the stock market. We got to have some discipline and see some of these stocks sell off. But Wix, I think, still has a lot of discount left. The intrinsic value of Wix is $2.99 based on cash flow and based on earnings per share. So if we have intrinsic value way above it, and you look at the Wix business, right? You go, this thing's sold off. Now it's selling off while the company is growing, expanding their cash flow and expanding their profits. That's a good mix. Buying a stock at the right time is really important. And this one here set itself up nicely for investors that buy a really good business at a discount that I think is going to rise another 40, 50, 60% over time. So Wix was another one. And, as we get on these live streams and investor calls, we had a terrific one this morning. I mean, we went over maybe 6, 7 stocks, and it's just an idea generator. We're kind of, hey, looking at Wix, looking at this, looking at that, looking at Upstart, and it's just an idea generator. Now, not every stock is going to look good. Some stocks just don't look good, and we'll call it out that way. I certainly will give you like my point of view. But I think the idea generator has been one of the big benefits of having a YouTube channel, having these live streams, because, I get fixated with the stocks that I have. And then when other people come up with stocks they think are interesting, it lets me get outside that box that I put myself in. And it's been really productive. All right. Let's talk about Pinterest. So do I see it similar to Reddit someday? Let's look at Pinterest. I think so. Pinterest is discounted. I agree. I think Pinterest is learning to make money, and that's going to make it more valuable. I think Reddit benefited from kind of seeing that, like, there's been some examples. Like, the best example in this space is Meta, right? They just make money. It's like they're they have like money making machines over at Meta. And Pinterest for a long time was this like very eye candy site that didn't know how to make money. They didn't know how to monetize. And I think they really have improved in that area. They're growing really well and they're making money. Are they going to be like Reddit? Maybe. Um, Reddit's a lot bigger now in market cap. This is only 24 billion. So I think Pinterest is going to continue to grow, do nice, do well. And I think Reddit's going to do well. I think the world's big enough for all of these to work. Just Pinterest has to avoid becoming the next Snapchat. That one's just been kind of bumping along the bottom. And Meta's been obviously the gold standard of the industry. And this one here was a nice little pickup to diversify a little bit. Reddit's been just a awesome stock. And Reddit was also a very obvious like situation, right? Now, I'm not the biggest Reddit user, but it IPO'd, and I stay away from IPOs. I don't like IPOs, too risky. And it went up, yep, as planned. And then it just crashed. And I was like, are you kidding me? You're going to lower Reddit to this level? And we talked about it. Man, boom, jumped in, bought shares, gave me enough time to buy a nice little lot. And then boom, it took off. So I'm up nicely on Reddit, like doubled my money. So that was an obvious opportunity. Now, Pinterest hasn't taken that kind of a ride, and I think Reddit's going to go higher. I think the Reddit business is really strong. They do it their way, and they'll never catch up to Meta, but they could totally be a really strong $100-200 billion market cap business. So that's really good appreciation for myself and other investors in Reddit. So Reddit was a nice situation. Now, as we get, you see Reddit, you see Meta, now Google's doing its thing, right? Google over the last 30 days, it's been something that I knew was coming because it's just a really valuable business. And I just thought the market was just nuts when it doubted Google, like, oh yeah, AI is going to destroy their search business. Well, I think it's going to change it. It's already changed it. And it totally ignored the fact that YouTube is the number one streaming platform on earth, growing faster than Netflix, growing faster from a percentage standpoint, and they're already bigger. And they have Waymo, the robo-taxi. They have their cloud business is growing really, really well. I could just go on. And the market was like, yeah, there's concerns. And of course, there was a Department of Justice story. Once that kind of was a monkey off its back, boom. I think this thing is going higher because look at this PE. You're going to see a lot of stocks of PEs of 36, 48, 60, 80. And man, 99% of those stocks cannot get even close to the moat, the importance, the value, the growth, the momentum of Alphabet. You look at their businesses combined, and these guys are gigantic. 371 billion. They're growing at 13%. Okay. And they could probably grow faster now because they could probably acquire some businesses, which would be a good idea. I think for a while they probably didn't acquire any businesses because, they didn't want to create more noise with the Department of Justice. But now that you have a pro-business, leadership team, I think they could probably acquire a couple business to help them, fill in a couple of gaps or opportunities that they can go after. So I think Google and a lot of stocks are moving higher, which leads me to just put it out there that, we're going to need to take some medicine at some point. We're going to need to let this market kind of sell off a little bit because this is great, but it's too good. You can't eat ice cream every day and not expect a bad outcome there. It's just a bad diet. And look how smooth this. I mean, look at it. And to think we in 2025 we just got smashed, which was a great opportunity. We treated it as such. Hey man, look at these stocks. They're getting discounted. Awesome. Christmas has come early. And then boom. So a correction, I think we can have a nice 5-10% pullback. I don't think anybody's going to complain too loudly just to get some of these prices down a bit because the market's just awesome, right? If you think about like who's doing well these days, right? And kind of like, let's get philosophical. Good to see you, Mike. Thanks for tuning in. Have a good night. And so the investing community or the investing class and is who's staying ahead or even getting ahead. If you buy equities, real estate, crypto, if you invest, you're taking your savings, your wealth, and you're expanding it. You're multiplying it. And that's who's staying ahead. The people that are either unaware of it or, out of fear, concern, apprehension, or they hear a lot of like noise and they sit on the sidelines and they kind of go, well, the market's risky. Remember 2008 or remember the dot-com bubble? Yeah, I do remember them. There were great opportunities. You heard it right. Great opportunities because you could have bought stocks at a discount and then made more money over the long term. So back to, if you're invested, this is an opportunity. If you're not invested, this just makes it harder for you. If you're not invested, that means the money that you have in your bank is worth less. And I think everybody should have either a career or a business or whatever to make income. Absolutely. But if you have a good investing portfolio, your portfolio works 24 hours a day, 7 days a week, 365 days out of the year. It works while you're sleeping. When you're nice and comfortable laying in bed, your capital is working. And as Warren Buffett said, if you don't learn how to invest, you'll be working till the rest of your life. Okay. And if you learn to invest, you'll be economically more capable. You'll have freedom. You'll enjoy it. You'll be empowered, all that good stuff. All right. Ryan H., a new member. Thank you, sir, for becoming a member. If you can send your email or just email me, I'm going to put my email on the chat here. I just want to get your details and send you all the information you ought to have. And we're going to look at TMDX. Good to see you, Michael Anthony. Yeah, Jamie Dimon. So I was a JP Morgan stockholder for a long time. And I get tired of Jamie Dimon making comments because he's lost a lot of credibility with me. He badmouthed crypto for a long time. Now he's okay with crypto because his bank can make money. And I don't know what to believe that he says. And of course, Kramer's Kramer. Very entertaining. But back to Ryan H. We're talking about TMDX. That's Transmedics. We looked at this stock recently. Market cap, $3.69 billion. And we have revenue of $531 million. P ratio is kind of high. And then analysts think it's discounted. It's had a bad month, a good year, a good year to date. And then the 1 year, look at that, sold off, then it came back. All right. So if I remember this right, commercial stage medical technology company engages in transforming organ transplant therapy for end stage organ failure patients in the United States and internationally. The company offers organ care system. So this is like a med device, right? So you have like a machine that keeps this organ in good condition while, somebody was a donor and they take the organ and then they get it to the person that needs it. And we have to get helicoptered over to that person. And here's the machine. Okay. So that's what the machine's all about. Now we looked at this and I think I have a valuation. We'll get to that in a second. So very good growth. Okay. Now it's not a gigantic business, 531 million, but this is a very good growth rate. We are seeing it slow down as they get bigger. No big deal. And free cash flow, not a lot of cash flow, but they are now positive. Gross margins, 59.79%. Okay. And they do have good profit margin in the trailing 12 months. So things are really looking up and up. Looking at their forecast, you got 9 analysts covering the stock. The best price target, most favorable one, $150 price target, $75 to the downside. Growth. So they're growing here, 38%, looks good. They're going to keep growing, keep growing, keep growing. Be $1 billion company in 2028. And their profits are going to grow nicely. So that looks good. So this is looking interesting. The market isn't completely bought in on the stock. That's why you had, rallies followed by some real big drawdowns. Let's see if I have a valuation on this one. If not, we can create one. Bingo. We're off to the races. So they have very little cash flow. So the cash forecast I put together, first it was discounted by 9%. I created it on July 30th. And this was the best I could do because, and I went through a process of trying to create a forecast. They have almost zero free cash flow right now. So I had to look at their margins and kind of set that up. And their growth is going to slow. So, even if I went, let's say 15% growth, which would probably be the limit that I'd want to go to, it just doesn't create a lot of intrinsic value because there's not a lot of cash flow involved yet. Okay. And added cash took away debt. So we're not up to the stock price. The cash doesn't support the stock price. And even their earnings per share doesn't support the stock price. And their margins are good, but they're not great. It's like 59%. Now, this one, can I be a little more optimistic? Probably, but I just can't get there. Now, this is a new company. It's younger, makes a machine, right? So they have to invest in the product itself. They have to make these things or have these things be made. They have to invest in inventory, all that good stuff. As opposed to some of these technology companies like a Reddit, they don't have to carry any inventory. They don't have to put a bunch of capital in the business. So this one here just doesn't value as well as we would have thought. But I'm just kind of putting it out there that, these businesses, they have good ideas, but from business to business to business, they have just different value. And this one here just doesn't make it for me. So thanks for asking about TRMDX. Kind of clean that up a little bit. And that's Transmedics. And please email me. And anybody who's a member that hasn't emailed me, email me so we can get all your information. You're welcome, Ryan. Please keep it coming, keep asking questions, and we'll keep looking at those stocks you're interested in. Do you know what happened to pins today? Did something happen to Pinterest? We just looked at it. So I think Pinterest, some stocks kind of faded today, but I mean, the monthly it's up 3.9. I'm optimistic this thing's going to do well. I don't know what happened. Looks like they were presenting at the Goldman Sachs Communicopia and Technology Conference. Moscow court fines Pinterest. They're not following Russian law. Okay. That happened a while ago. All right. So, Sam, good to see you. NBIS. Is that Nebius? Because they rocked the world today. They went up 49%. Now, I do have thoughts on them. I'm not a buyer of Nebius, and I did look at them when I saw this nice rise. Now they're going up really nicely. These guys are in cloud computing, not cloud computing, cloud infrastructure, and this is like the premium stuff. Now their heritage or their history, they actually started in Russia and they had a different type of business, which I think they sold off, and now they want to be a hyperscaler for AI, meaning they have the super clusters. Somebody can come to them. They can help build out the super cluster. All right. So it's a $22.85 billion market cap company. And we've been looking at this for a couple months. And a couple of things that make me nervous. Okay. So in 2021, you're 4.7 billion. You kind of got rid of that business. You started this new business at 13 million revenue. You moved it to 20, and then you started to grow. So the growth is good. No denying that. But let's look at their other fundamentals. So free cash flow, there is none. They're putting a lot of money into their data center. Their gross margins are trying to stabilize. Looks like they're going to be 50, 60% gross margins. And these numbers are kind of wacky. So I'm going to look at their financials and kind of look at their compares. When we look at their debt, this is where these CoreWeave and these guys, they don't have a lot of debt. CoreWeave has a lot of debt. These guys are okay. So let's take a look at their website, and then we'll take a look at their actual financials, because stock analysis seemed like they didn't have the right information. I have looked at Nebius. It didn't make it on my radar. So let's take a look. So they're 105 million. I showed you how they came down, then they came back up. See how the revenue is really low, and then it's gone up. Okay. So here's cost of revenue. Here's 2025 cost of revenue, 30 million. They're depreciating a lot of their hardware in the data center, like the GPUs they bought. They're depreciating them. Okay. Okay, so here's their cash, debt. So they don't have a debt problem. That's good. So they're losing 231 million. So 156 of revenues. Cost of revenues is 54. So they're Their gross margins are 54, so that's going to be about 65% gross margin. So that's pretty good. And a lot of money is going into depreciation, which this comes back on the statement of cash flows. So the rest of it is sales, product development, and that's about it. So I don't have a statement of cash flow, but this one here, it looks like, they're having a great day, and there's just too many things going on for me to get comfortable with it. And I've just have not gotten comfortable with it. Now, am I invested in the data center? Absolutely. I own Amazon. I own Google. I own other stocks that have data center operations, and I have plenty of exposure there. This one here is like, I don't know if these guys are going to do great over the next year or 2 years. Their financials don't lend themselves that where I was very confident in them. And now they're rallying up. Good for them. Good for investors in it. And I don't think I would have changed anything that I would have done. I think they're rallying similar like CoreWeave. I thought CoreWeave was way overpriced, and it's really come down. This one here, I can't say that because I think some of their fundamentals look a lot better. They don't have a big debt problem like CoreWeave, and their margins look pretty darn good. But they are in the Netherlands. It's just this is a risky business. If the demand for AI and the GPU superclusters comes down, these guys are toast because they're going to be sitting on a lot of expensive hardware that's idle. That's going to be a problem. They also are kind of a one-trick pony. This is the only business they have. Whereas like a Google, they have their cloud business, but they also have YouTube and 10 other businesses. So maybe when the cloud business isn't doing well, every other business is doing well. So they can kind of diversify their revenue streams. Same thing with Amazon. Amazon has the biggest hyperscaler business, and they have e-commerce, the biggest e-commerce business. So they both complement each other and can kind of cover one another. When one's down a little bit, the other one can kind of pick it up. So that diversification with those companies I really like. And NBIS, for those that own it, congratulations. I think over time, as we see better financials, maybe I'll change my tune about it, and we'll be able to do a valuation. Right now I can't because they lose money and they don't have free cash flow. So I would come up with a 0. Thanks for asking about that, Sam. And I think over time I'll have a better answer on Nebius because their financials will get better. I'll continue to look at it. All right. Ryan, my portfolio, 20%. ADF Group, Canadian small cap. Cool. ADF. So these guys, ADF Group engages in the design and engineering of connections, including industrial coatings in Canada and the US. It fabricates and installs complex steel structures, heavy steel buildups. Cool. Okay. Whoa. Nice 5-year. It really ran up. 1 year hasn't really gone anywhere in a year. It's a small cap, 276, and this is in the Canadian currency. 1-to-1 on revenue to market cap. PE is super low. So they have seen a pullback on revenue. Is it because of the tariffs? Yeah, they saw a big pullback. Yeah, tariffs may be affecting their business. If they're getting a lot of the steel, especially from the US, or if they're selling a lot of their product into the US and those tariffs are kind of getting in the way, that might be causing this big drop in revenue. They were doing really well for a while, and then They slowed down middle of 24, and they've continued to slow down. Okay. Let me take a look at their product really quick. All right, so we'll go English. So these guys are in big construction. Look at that. So these are complex metal structures like bridges. All right, so like this stuff. Okay. So these are steel. Makers of steel structures. Okay. Yeah, this is a space that I think the U.S. leadership is really defending quite harshly, and that's what might be causing some of the reduction in revenue. So we have revenue that's coming down. It's not good. And this is more of a engineering construction company. You see the cyclical nature of this business. You have revenues who've come down. They get a couple projects and they're big. Revenues go up. They finish those projects. Well, they have a lull in the business, and they get a couple projects and they grow, and then they come back down. So it's almost like they get busy. They fill their capacity, and they keep this cyclical cycle keeps happening, up and down, up and down, up and down. And that's engineering construction. So not an industry that has proven to create a lot of wealth. You don't see like big giant construction companies like their value. It's not like, oh wow, look, there's Meta, Google, and a big construction company. No, they just don't accumulate a lot of worth. And this one here has had a rough year because the business has slowed down. But hopefully it picks up. And do they pay a dividend? Small one. So cool. And what I'd be curious is what your age is. Are you young, old? So tariffs don't really affect them. They take the steel, transform it. So they have a good backlog. Margins 20%. Cool. Yeah, this particular industry, they hire well-paid, usually union workers, which is great. They employ a lot of people, but let's take a look at those margins. Yeah, their gross margins at 30%. And that's like automotive industry. These are low margin industries compared to the 80%, 85% margin businesses like Palantir or Meta or Reddit. Reddit is like near 90% margins. Those are the businesses that can really, skyrocket. So, yeah. Depending on age, like for a young investor, go find Reddits, Metas, Palantirs, Nvidias, and they're out there. And right now it's harder because everything's so expensive. For older investors, you might want to have more stability, buying well-established companies that have a diversified and so forth. So that is DRX. Thanks for asking about that one. Did you add any app the other day? So it's been hard to add AppLovin because the stock, I've been trying to buy it on any kind of pullback. I've been buying it. It's really gone up. It went up kind of quick, but it did give me a couple opportunities and I bought it. Did I buy more today? I think I did buy some shares because I think intraday it was trading down here and I bought some shares. So yeah, I've been trying to add to AppLovin. It's a really good business. I kick myself on this one because the stock in 2024, I thought it was a good stock. I bought it, made some money, sold it, and then thought, oh, look, I did the right thing, came back down, and then it shot up. So now I'm just trying to catch up with it. I should have stuck to this really good business. These guys are really killing it. They had a story come out, a short seller said, oh, they're not using the privacy rules correctly. and so forth. But that was just nonsense. These guys are killing it. They're growing the fastest. They're accelerating their growth. Look at this growth. It's insane. 77%. And not only that, look at their margins. So free cash flow is coming out. Cash is coming out of their ears. And their profit margin, 42%. Gross margin, 78.6%. This is like crazy money, crazy profitability. So this one, these guys, man, I just got to keep my grubby hands off these shares, just keep adding and set it. If they don't change their business model and they just keep getting better and better, just keep this sucker because it's been going up nicely. Yeah, we live in, sometimes we have to pay for lessons learned. And this one here, I had to pay a pretty good little price for selling AppLovin. But that's just, investing is a process of learning, getting better. So right now it's fairly priced and I'm buying shares. I think the company will continue to grow their value as they get bigger. And I'm good owning AppLovin. I'm up nicely on it, but again, I kicked myself because I could be sitting on like a 150% gain. And instead, I took a nice 40-50% gain months ago, maybe 6-8 months ago. And now I'm sitting on a 25% gain. I could be sitting on a nice 150% gain instead, but lesson learned. So we went over, Aaron, we went over Lululemon the other day. You can look at a video on my channel, or you can buy $5 super chat and I'll take a look at Lulu. And then same thing with Webull. I've got a video on the channel. And then Elon, Robinhood. I love Robinhood. I own a lot of Robinhood. You got it. But I'm not going to beat myself up about it because, like, for example, Robinhood, I'm up 600% on Robinhood. I'm up a ton on Meta. I'm up, on all these stocks. So, yeah, you know what? Missed a couple, and I kept a bunch that are really good, and that's that. AppLovin will help me, keep a tight grip on all those awesome stocks that I didn't sell. So that's how I'll end that little segment. All right, guys. So I've been going for about 2 hours. Thanks so much for tuning in. I appreciate it very much. I hope you found the session interesting. I really enjoy doing this, and I enjoy you guys bringing up stocks that are cool to watch. And for all those that are not members yet, take a look at the member programs. If there's one that's good for you, that'd be great. You get your name comes up a little different on the live stream, and I could, answer any questions you have around a stock, value a stock, and so forth. Take a look, and all the members are out there. Thank you so much. And Buddha Tan, thanks so much for becoming a member. I think you became a member yesterday. And if there's a stock, I'll work a little overtime. Maybe you just joined. If there's a stock you want to look at, I'd be happy to look at it. Appreciate you becoming a member. So let me know. I'll stick around for another 5-10 minutes and see if there's a stock you'd like me to take a look at. And I'm going to put my email address again for Booty Tan, and then Ryan. Anybody else who's a member that you haven't emailed me, just email me so I have your information and get you all the perks. And I'm going to put my email in here. Email me. I'll have your email. I can send things to you. And we're going to cover Reddit. Good news, Booty. This is one of my favorites because I think there's a lot of lessons in Reddit. So when we look at Reddit, I like this chart look. So this stock IPO'd, and this IPO it was a little bit surprising that it didn't shoot up like, like a bottle rocket. It kind of went sideways, and then got crazy. And then it settled down. Like it just sold off. Like it's not very desirable. And this is where I started paying attention like, hey, this thing is a good company and their fundamentals look really good. So it was a really good buying opportunity here. And I seized it, bought it. It's been going good. And it's a stock that, with patience can really work. Let me show you fundamentals, and then we're going to get into the valuation I have for it. It's already a $45 billion market cap company. Revenues are 1.67. So you're paying a lot of times revenue for the company because it's growing so fast. PE is 207, forward P 103. Analysts think it's priced 26% too high because it really has gone up really fast, right? It's really jumped up. Now the growth is great. In their last earnings, they really kind of put their pedal to the metal and increased their growth rate, which is always good to see that they accelerated growth. They're already $1.66 billion revenue company growing at 70%. That means that they're going to double very quickly at that rate. Now, the piece that makes this stock really, really attractive is they're already cash flowing, because Reddit doesn't have to like buy factories and buy materials to make products and so forth. They have these platforms, and these platforms are what we go on and communicate with one another and talk about, different communities within Reddit and talk about a topic and so forth. So it's very efficient or low cost way of getting revenue in, and they make money on advertising. Look at these gross margins, 91%. That is extremely high. And they have profit, cash flow. So that makes them very special. When you got this kind of profitability, these businesses are very special. And that's why I really paid attention to Reddit. The analysts, the stock's risen so fast, they can't update their stock targets fast enough. Now, when we look at the valuation of Reddit, I'm kind of in agreement with the analyst that, hey, it's a little too expensive. Now, it's a great business. I want to buy more shares. I just have to be patient. I'll pay fair price for this company, but I can't pay 29% premium, because if we have a strong pullback, maybe Reddit gets pulled back 20%, gets closer to, fair value, then I'm a buyer. I'm not selling any shares. I'm keeping my shares, and I'm waiting for the right time to buy more shares. And it's just a really good business. But patience is one of those skills, one of those successful habits in investing. Buying stocks under the right conditions is really important to make money. I can't buy stocks that are priced too high. Even though I love the business, can't buy them when they're priced too high. I'll hold them when they're too high because I don't want to sell my Reddit shares. I just talked about AppLovin and making a mistake of selling it when I thought it was priced too high. So Reddit's staying in my portfolio, but I need to be patient before I buy more shares. So that's my analysis on Reddit. Thanks for asking. And thank you for being a member. Thank you for tuning in. All right, guys, we'll be back in the morning. I'll be back in the morning at 9 a.m. Eastern, 6 Pacific with Daryl. I'll handle fundamental analysis. He'll do technical charts. And then I'll stream again as often as I can this week. Maybe tomorrow, maybe Thursday. And look forward to seeing some of you then. And thanks again, everybody. Have a good night. Take care.